Welcome to today's Market Matters video update. I'm Harry Watt, joined by James Gerrish. It's Friday, the 16th of June. We are a little bit away from May. We've delayed this video a touch, about a fortnight into the new month. But casting our minds back to May, James, just setting the backdrop of how markets performed. Market was down a little bit, but most of that came back end of the month, James. What happened there?
Yeah, a couple of obvious points in May. So the index, the ASX 200 accumulation index was down 2.53%. But when you look under the hood, there was some huge variance across the sectors playing out. So you had things like the IT space that really came back into favour. It was up 11.6% locally. That was driven by strong performance over in the US market in terms of their IT sector. But then you had the likes of the retailers, the discretionary retailers were down over 6%. The staples were down nearly 5%. The materials were off 4.5%, and the financials were down over 3%. So there was a huge amount of if you weren't in tech, you were struggling during the month. So I think that's a theme that's going to continue to play out as the remainder of calendar year 23. Obviously, the start of FY financial year 24 happens in a couple of weeks' time. So we think that level of disparity between sector performance and the stocks that have performing well, we think will continue to perform well, and it lends itself to active management. We've been speaking about that for a while now. We are talking our own book, but we think it's a period where you need to be agile and be trying to position your portfolios in the sectors that have got tailwinds and trying to avoid the ones that have got headwinds.
Definitely. And given that backdrop, James, in terms of Market Matters portfolio performance in May, how did we go in that respect?
Yeah, so I've got to say some variance across portfolios. It wasn't a great month from a portfolio perspective. So I'll run through the numbers now. The flagship growth portfolio was down 1.6%. So keep that in your mind with the backdrop of the ASX down over 2.5%. So that was a strong relative performance. To give you some idea on numbers, that over the past 12 months, that portfolio is up about more than 13% against the benchmark, which is up less than 3%. So that's had some really strong outperformance. The income portfolio had a really soft month. It was down 2.25%. Again, it has has allocation to equities, but also debt instruments, hybrids, and the like. So I was a little bit disappointed with the income portfolio over the course of May. International equities fell 1.5%, and the emerging companies continued to struggle. It was down 5.2%, even against the backdrop of the Small Ords accumulation, which was down about 3.2%. So some choppy performance across a suite of Market Matters portfolios. Not a great month, but we look forward to June, and June has started really well for the first 2 weeks of June. So the portfolios are up fairly substantially over the course of the last 2 weeks.
Earning some back in the markets, acting favourably in that respect as well. In terms of the growth portfolio start, James, tech you mentioned was the big outperformer. We owned some tech in that portfolio. We lightened the load on Xero a little bit there. We continuing to see that sort of trend play out. We continue to see that lightening of tech in that portfolio.
So the outperformance that I spoke of just earlier over the past 12 months, it's been largely driven by our big overweight towards technology. So over the course of the 12 months, we've been pretty heavy in the tech space. We went a little bit early going overweight the tech space, and we've started to trim it. And we've probably trimmed a little bit too early, to be honest with you, Harry. So Xero, you made mention of, they had an update during the period, really strong update, and they're doing a really good job in starting to massage their business more towards profitability. So they were spending the majority of their revenue in growth. That's now taken a more balanced approach. So they've pre-guided to operating expenses of 75% of their revenue, which is, it might only seem small, but it's a big change when you're dealing with over 3.7 million subscribers. So their subscriber growth was great. The average revenue per user that that they're getting out of their subscribers is really strong. The bulk of the business is doing really good things. So we had Xero was one of our largest positions in the portfolio, so we have trimmed that back. During the period, we still have a 3% portfolio weighting to Xero. It's trading around $116 today, so it's been a phenomenal performer over the course of the last 6 months or so. When you think about it, was trading sort of $60, $70 not that long ago. So still like it, still going to hold it, but we trimmed into strength, and which is sort of what we're going to be doing in terms of the rest of our portfolio positions. We're very much aligned with trimming strength and tweaking portfolios as opportunities arise.
Absolutely. One of the performers, one of the stocks in the portfolio that underperformed was Ramsay. We've struggled with this position a couple of times, James. Just run us through our thinking on Ramsay here and now.
I reckon it's a stock that I'm not sure I've ever made money out of Ramsay, and it's quite a frustrating position for us. We've got in the flagship growth portfolio. They came out with a trading update that basically showed turnaround from COVID, but we were expecting that. So our thesis was around all this pent-up demand for elective surgeries will drive really strong earnings growth this year and into next. We were looking for earnings growth of sort of 13-14%. They came out and said they were producing a number around 10%. That was a disappointment from a market's point of view, and a disappointment from our point of view. So the trends are going the right way. It's just taking longer to get there. So we're sticking with it at the moment. It was a detractor from the portfolio. I think from memory it took about 0.7% off portfolio performance during the month. To give you some context around what a position that falls meaningfully does to our portfolio. So healthcare at the moment's been a little bit choppy. We had CSL out this week. They came out and put a lot of cold water on analysts' bullish assumptions for FY24, and that stock has fallen pretty meaningfully as well. We've cut that position. We had trimmed it at higher levels, but we've now cut it out of the portfolio. So, we're probably going to be a little bit more aggressive, brutal with those companies that are missing our expected numbers from now on, Harry.
Yeah, it's important to note we still did take a profit on CSL on that last leg, despite it coming off. One thing we've hung our hat on for a while now is that income portfolio. The performance has been really strong for a long time, and the volatility of that portfolio has really been really nice to see in terms of what that's trying to achieve. It did underperform in the month. What sort of played out into that underperformance from the income perspective?
So to give you an idea, just to step back a little bit, over the last 3 years, this portfolio has done over 13% per annum for 3 years. Its RBA cash plus 4 benchmark is under 5%, so it's had about a 7.5% outperformance each year for the last 3 over its benchmark. Financial year to date, it's up 9%, etc. So consistency in this portfolio in terms of performance is what we're really trying to achieve. Consistency in income, but overall lower volatility, but a consistent return for investors out there. Decline of 2.2% for the month was disappointing. It was sort of like, I look across the portfolio and there wasn't one area that really struggled. There was a lot of areas that struggled. A lot of stocks sort of took that 30, 40 basis points off portfolio performance. But I think the key was around the fixed income allocation as well. So it's got a reasonable weighting in hybrids. Spreads in hybrids moved out during the month. So they're up from sort of 2.5% to 3% during the month. Obviously, with the RBA raising interest rates, the return that we're expecting moving forward on the hybrids increases, but that risk margin over and above the 90-day bank bill rate widens. So I think they're more reasonable value now. I think they were expensive before, more reasonable value now. Obviously, hindsight's a wonderful thing, but they're continuing to deliver what we expect them to deliver, but they were a drag on overall portfolio performance for the income portfolio in May. But stay the course would be my view. We've recently increased our hybrid allocation to that portfolio as a consequence of some of the sell-off in the prices of the hybrids.
It's important to note CBA came out with a deal in May, and that obviously needs a bit of liquidity to fill, and you obviously see spreads widen as a result of that as investors take profits in other hybrids and move into that deal.
100% right, and they issued it a 3% margin over bank bill, which I thought at the time was a pretty Like they did the right thing by investors, CBA, issuing at that. They probably could have issued at a tighter rate. They didn't. That's a good hybrid, and that came on during the month as well at a premium to the issue price. So that's a. But as you may mention you do when you get a new issue, it drags some liquidity out of the market.
With the end of financial year just a fortnight away now, James, June has started pretty strongly. We're up about 1.8% for the month, and once again, massive sector divergence playing out here. We've seen that into the end of financial year. Where are we putting this market in a couple of weeks' time?
So yeah, you hit the nail right on the head there. So it's a little bit different in terms of what sectors are performing though. So far in June, the materials sector is on a tear higher. So it's up over 6% this month to date. So that's been a really strong outperformer in terms of the broader market, and we expect that theme to continue. Yesterday we ran a webinar on resources into FY23. I had Todd Warren from Tribeca Investment Partners and Andrew Hines, who's our head of research at Shaw, come in and give some ideas around the bigger picture of resources and the stocks that they're backing to take advantage of their bullish views in some of the specific commodities related to decarbonisation. It shows you it was a really well attended webinar. Had a huge number of registrations onto it, probably the most we've had in about 18 months. So that shows you there's a lot of interest coming into the materials space. We think it's going to be a huge opportunity for knowledgeable investors over the course of the next 12 months, 24 months and beyond. So having knowledge in that area, because there's a lot of intricacies in investing in material stocks, and I think timing and whatnot is really important. We saw that at the back end of 2022, where everyone was very bullish on things like lithium and the like, and then they collapsed. Some of the big mining companies pulled back really hard at the back end of 22, early calendar 23. So you've got to have your finger on the pulse in resources. That's what we try to do at Market Matters, and we're like everyone out there. We're trying to set the best portfolios that we can, but ultimately, to your point around technology and resources, we are reducing tech and we are increasing resources across our portfolios, Harry.
Pretty timely webinar given the backdrop of potential stimulus coming out of China again, and we know that tends to drag those resources stocks higher for a long period of time as well. But for now, that's all we've got time for today's video. I hope you got something out of that, something to take home and invest with. And as always, continue to look out for the Market Matters reports for continued daily updates for our view on the markets.